Types of liabilities. Liabilities are a company's legal debts or obligations that arise during the course of business operations. Liabilities are settled over time through the transfer of economic benefits, including money, goods, or services. Recorded on the balance sheet, the right side, liabilities include loans, accounts payables, mortgages, deferred revenues, and accrued expenses. Liabilities are a vital aspect of a company's operations because they are used to finance operations and pay for large expansions. They can also make transactions between businesses more efficient. For example, the outstanding money that a company owes to its suppliers would be considered a liability. Outside of accounting and finance, this term simply refers to any money or service that is currently owed to another party. One form of liability, for example, would be the property taxes that a homeowner owes to the municipal government. Liabilities represent obligations stemming from a company's 1. Operating activities and 2. Financial activities. On the balance sheet, liabilities are divided into two categories. 1. Current liabilities. These are liabilities that are due within 1 year, and they are reported in order of maturity by amount or in the event of liquidation. 2. Long-term liabilities. These are obligations not due within a year. To qualify as a liability, an obligation must be measurable and its occurrence must be probable. Common types of liabilities. One is accounts payable. This is a company's obligations to suppliers for services and products already purchased from them, but which have not been paid. Represent the company's unpaid bills to its suppliers for services obtained on credit from them. Next, you have notes payable. This is debt or equity securities held by the company. Next, you have current portion of long-term debt. This is the portion of debt with an overall maturity of more than 1 year, the portion due within 12 months. The next type of liability is long-term debt. This is the company's borrowings with a maturity, full repayment, exceeding 12 months. Next, you have deferred taxes. And remember, we discussed this is the potential future tax obligations arising when taxes payable to the IRS are lower than those recorded on financial statements. And lastly, you have minority interest. This is the equity interest in the portion of the consolidated businesses that the company does not own.